Here's something strange happening with Stryker right now. The stock has dropped nearly 20% over the past year, yet Wall Street analysts are still calling it a buy, with a price target that's more than 22% above where it's trading today. That's not a small gap. That's the kind of disconnect that makes you stop and ask, what does the market think it knows that the analysts don't, or is it the other way around? First, let's look at how the business is actually performing because the numbers here are surprisingly strong. Over the past 12 months, Stryker brought in $25.27 billion in revenue and kept $3.34 billion of that as pure profit. Its gross margin, meaning how much money is left after just the cost of making its products, sits at an impressive 64.7%. That's the kind of margin that usually signals real pricing power. But here's where things get interesting. Even with margins that strong, the company only keeps 13% of revenue as final profit. So where does the rest go? Operating costs, taxes, interest on debt, all the expenses that separate a good product from a great business. Now, here's a number that trips a lot of investors up. Stryker's trailing P/E ratio, basically how much investors are paying for each dollar of past earnings, is 36.41. At first glance, that sounds expensive, but here's the twist. The forward P/E, which looks at expected future earnings, drops all the way down to 20.04. That's almost half. This is where investors often get confused, because it suggests the market expects earnings to grow significantly. And when you factor in growth using the P/E ratio, which comes out to 1.86, the picture becomes a bit more balanced than the trailing number alone would suggest. But let's talk about that debt we mentioned earlier, because this is where the story gets more complicated. Stryker holds $2.97 billion in cash against $15.23 billion in debt. That means the company is sitting on a net cash position of negative $12.27 billion. In other words, it owes far more than it holds in cash. And yet its current ratio, which measures whether it can cover short-term bills, is a healthy 2.11. So short-term, the company looks safe. Long-term debt is the real conversation here. Here's a pattern interrupt most people scroll right past. Stryker's Altman Z-score is 5.42, and its Piotrowski F-score is a perfect 7. Without getting too technical, these are two separate systems designed to flag financial distress or weak fundamentals. A high Altman Z-score suggests low bankruptcy risk, and a high Piotrowski score suggests improving financial health. Combine that with a return on equity of 15.2% and a return on invested capital of 11.82%. And you start to see a company that's actually converting its resources into real profit efficiently, not just growing for the sake of growing, and yet the stock keeps sliding. It's trading below both its 50-day average of 311.99 and its 200-day average of 344.57, which technically signals a downtrend. Its RSI sits right in the middle at 47.48, meaning it's neither overbought nor oversold, just quietly drifting. So why isn't the market rewarding these fundamentals? That's the question every long-term shareholder is probably asking right now. One more thing that's easy to overlook, Stryker has increased its dividend for 16 consecutive years, growing it 4.82% just this past year, while only paying out 40.28% of its earnings as dividends. That leaves plenty of room for the dividend to keep growing. Combine that with institutions owning nearly 81% of the stock and short sellers betting against less than 2% of shares, and you get a picture of a company that professional money isn't rushing to bet against. So where does that leave us? On one hand, you have strong margins, efficient capital use, a growing dividend, and financial health scores that suggest real stability. On the other, you have real debt, a stock price stuck in a downtrend, and a valuation gap between what the market is paying today and what analysts expect tomorrow. The real question isn't which side is right, it's this. When a business's fundamentals and its stock price start telling two different stories, which one eventually catches up to the other?